Please like, share, and subscribe. Wishing you happiness and good luck every day.
All right, we are going to try and crack the code on the world's most successful investor, Warren Buffett. And look, this is not about hot stock tips or anything like that. This is about a philosophy that has stood the test of time. We're using the Warren Buffett Accounting Book as our roadmap to really nail down the 4 key principles that made him a legend. So let's get into it. Have you ever looked at the stock market and just thought, this thing doesn't feel like a rational system? It feels more like a person who's super unpredictable. One day they're on top of the world, everything's amazing. The next day they're in a total panic, thinking it's the end of the world. It just doesn't seem to make a whole lot of sense, right? Well, guess what? If you've ever felt that way, you are in very good company. Warren Buffett's mentor, the one and only Benjamin Graham, he basically said that's the exact right way to think about it. He actually took this crazy, irrational force and turned it into a character he called Mr. Market. So let's get to know this Mr. Market guy, because really understanding him and, more importantly, understanding your relationship to him, that is the absolute first step if you want to start thinking like Buffett. So Graham's story goes something like this. Imagine you have a business partner, and it's Mr. Market. Every single day, he shows up at your door and he yells 2 prices at you. One price where he'll buy your shares and another where he'll sell you his. The thing is, his prices are all over the map. On his good days, he's euphoric, and he'll offer you ridiculously high prices. But on his bad days, he's totally depressed, and he's practically giving his shares away. And here's the best part, the most powerful part of this whole idea. You can completely ignore him. You can take his offer if it's great, you can buy from him when he's panicking, or you can just shut the door and say, nah, not today. And he'll just come back tomorrow with a totally different mood. And that just perfectly sums up the entire lesson, which Buffett captures in this quote. Mr. Market is your servant. He is not your guide. A guide tells you what to do, where to go. No. He's your servant. He's just there to offer a service, and you decide if and when you want to use it. You get to take advantage of his moods. You don't let his moods control you. He works for you, not the other way around. Okay, so if Mr. Market is basically just a bunch of daily noise, what should we actually be paying attention to? Well, this brings us to a huge mental shift. It's really what separates a value investor from pretty much everyone else. This right here. This is the secret sauce. It changes the entire game. You have to stop thinking that you're buying a ticker symbol, a little blip on a screen that you hope goes up. You're not. You're buying a piece of an actual business. You become a part owner. You own a piece of their brand, their factories, their employees, and most importantly, their future profits. So you've got this fork in the road. On one side, you have the trader. They're obsessed with price. They're glued to every little thing Mr. Market does, and all their decisions are fueled by emotion, right? Fear and greed. Their timeline is right now. But then you have the investor. They focus on value. They think like a business owner, using logic to figure out if the company is healthy for the long term. They could care less about Mr. Market's daily drama. Their timeline isn't today, it's years, maybe even decades. And here's another gem from Graham that explains why the investor's way of thinking usually wins out. In the short term, the market is just a popularity contest. It's a voting machine. It's all about hype and what's trendy. But in the long run, the truth comes out. The market becomes a weighing machine. A company's real fundamental worth, its earnings, its assets, its actual substance, that's what ultimately determines its price. The investor's job is just to figure out that true weight and then be patient. So we've got the mindset down, but just having the right attitude isn't enough, right? How do you actually find these great businesses when Mr. Market is offering them up at a fair price? Well, Buffett boils his whole method down to a really simple but incredibly powerful 4-point checklist. And here they are. Think of these as 4 hurdles that any potential investment has to clear. First, are the people running the show smart and honest? You're trusting them with your money. Second, is this business going to be around and making money 10, 20 years from now? Third, can you personally explain what this company does in a simple sentence, and is it built to last? And finally, the last hurdle, after all that, is Mr. Market in a bad mood and offering you a price that's a genuine bargain compared to what the business is actually worth? You need a yes to all 4. You know what? Let's just zoom in on one of these to see how it works. Let's take principle number 3. The business must be stable and understandable. Now, that sounds simple enough, but what is Buffett really getting at here? He uses one of his most brilliant analogies for this, the economic moat. He says, a great business is like a castle. and the profits are the treasure inside that castle. So the most important thing for that castle is to have a big, wide moat around it. That moat is its competitive advantage. It's what protects it from competitors trying to storm the walls and steal the treasure. This could be a powerful brand, a key patent, anything that keeps rivals at bay. And understandable just means you can clearly see the castle and you understand why its moat is your effective. Okay, so how do we actually analyze all this stuff? How do we measure how wide a company's moat is, or how good its leaders are, or what a good price even is? Well, to do that, you have to learn how to speak the language of business. And according to Buffett, that language is accounting. He's been really clear about this. You can't be a great investor if you can't read financial statements. Trying to pick stocks without knowing accounting, he says, is like playing a high-stakes poker game, but you're not allowed to look at your cards. You're just gambling at that point. Now, I know becoming fluent in a new language sounds like a lot of work, but it really boils down to 3 key documents. You've got the income statement, which is like a movie of the company's profits over a year. Then there's the balance sheet, which is more like a single snapshot in time of what the company owns and what it owes. And finally, the cash flow statement. That one's kind of like a detective story, showing you exactly where the cash came from and where it all went. This little cartoon does a great job of breaking down the balance sheet. Just think of it like a scale. On one side, you've got all the company's stuff, its assets. And on the other side, you have how it paid for all that stuff. It's either liabilities, which is money it borrowed, or equity, which is the owner's own money. And the key rule here is that those 2 sides always have to be in balance. All right, this is where it gets really cool. This is where we connect one of Buffett's big ideas, that a company needs to be stable, to a real, actual number that we can find in the language of business. So the big question is, how do you actually measure something like stability? I mean, how do you put a number on risk? Well, one of the best ways to do it is to look at how much debt a company is carrying. A business with a ton of debt is fragile, but a business with very little debt, now that's a business that can weather a storm. And where do we find that? We go right back to the balance sheet. Now, I know this can look like a wall of text, but don't worry about it. We're only hunting for 2 specific numbers. In that liabilities and equity section, how much debt the company has and how much money the owners have put in. We're going to compare those 2 numbers using a really simple but powerful tool called the debt-to-equity ratio. All you do is take the company's long-term debt and divide it by the total equity. What that final number tells you is how much the company is relying on borrowed money versus its own money to run the business. A really high number means it's leaning heavily on lenders. And this is the payoff. This is the simple rule of thumb that Buffett himself uses. He likes to see companies with a debt-to-equity ratio of less than 0.5. So for every dollar of the owner's money in the business, there's less than 50 cents of debt. And why is that so important? Because a company with low debt is its own boss. It has the freedom to survive a tough year and the flexibility to jump on opportunities when everyone else is scared. It's a sign of a very, very stable castle. And just like that, we've gone from a big picture philosophy about Mr. Market all the way down to a specific number on a financial report that you can use to make a smarter decision. So here's the bottom line. Once you get the whole Mr. Market story and you internalize Buffett's 4 principles and you learn just the basic grammar of accounting, your whole view of the stock market just changes. You stop being a passenger getting thrown around by every scary headline. You become the pilot, calmly analyzing the business and making your own logical decisions for the long haul. Look, we've basically just handed you the first chapter of the dictionary for the language of business. The stories of thousands of companies are out there, written in that language, just waiting for someone to read them. So really, the only question left is, which business are you going to learn to read first?
All right, let's talk about the stock market, because today we're going to try to completely reframe how you look at it. I want you to forget all the flashing numbers, the scary headlines, and that constant feeling of stress. By the end of this, you're going to see the market not as a source of anxiety, but as a world of opportunity. So let's jump right in.
Seriously, what if it is? What if all the daily ups and downs that you see on the news, all the drama, what if it's actually just noise? And what if the real key to success isn't about trying to predict all those crazy movements, but about learning to pretty much ignore them entirely? That's the huge shift we're going to explore.
Okay, this right here, this is probably the single most important idea in all of investing. I mean it. See, most people look at a stock and they just see a ticker symbol, a little blip on a screen that goes up and down. But the people who really succeed, the value investors, they see something completely different. They see a business, A real, living, breathing company with actual employees, products, and profits. And that one tiny shift in perspective, well, it changes absolutely everything. So let's dive into this different point of view. This is the core philosophy of value investing, and it's what separates people who are just speculating from true investors. It's all about understanding that you're not just placing a bet on a price, you're actually becoming a part owner of a real enterprise.
And this is so crucial to get. It doesn't matter if you own 1 share or 1 million shares. The principle is exactly the same. You are a business owner. That means you have a claim on the company's assets and, more importantly, a slice of all its future earnings. Sure, Warren Buffett might own a much bigger piece of Coca-Cola than you do, but when you buy even a single share, you are literally his partner.
Now, to really get a handle on how the market behaves, we need to meet someone. He's a fascinating character invented by the father of value investing, Benjamin Graham, to help us students, including a young Warren Buffett, understand the wild psychology of the market. So let's meet Mr. Market. Okay, so imagine Mr. Market is your business partner. And every single day, without fail, he shows up at your door. He offers to do one of 2 things, either buy your shares from you or sell you more of his. But here's the catch. His mood is completely unpredictable. He isn't driven by logic or reason. He's driven entirely by emotion. So on some days, he shows up just euphoric. He's over the moon. The news is great, everyone's buying, and he's giddy with optimism. He looks at the business you own together and offers you a ridiculously high price for it because he's convinced things can only get better and better.
But then you open the door on other days and he's a total wreck. He's absolutely terrified. He just read a scary headline. He's convinced the world is ending, and all he sees is doom and gloom. On these days, he's desperate to sell, and he will offer you the exact same business for a fraction of what he was asking for just yesterday. The whole store is on sale.
And this perfectly illustrates one of Graham's most famous ideas. In the short term, the market is just a popularity contest, a voting machine. It's driven by Mr. Market's moods, by fear, and by greed. But over the long run, all that emotion fades away, and what really matters is the actual substance of the business, its weight. How much profit does it actually generate?
And this leads us to the great deception of investing, the trap that so many people fall into. It's the idea that the price Mr. Market is screaming at you today is the same thing as the actual, real-world value of the business. And let me tell you, they are almost always 2 completely different things. And listen, this is not a new thing at all. History is just littered with examples of Mr. Market getting totally carried away, times when price completely disconnected from reality. Back in the 1600s, people were trading a single tulip bulb for the price of a house. In 2000, internet companies with 0 profits were valued at billions. In 2008, house prices soared way beyond what they were actually worth. In every single one of these cases, Mr. Market's euphoria eventually slammed into a wall of reality. Bubbles always pop. So, if we know Mr. Market is basically a moody, emotional wreck who's often wrong, how do we actually use that to our advantage? This is where the whole mindset just flips on its head. We learn to see his bad moods not as a threat, but as our single greatest opportunity.
I mean, just think about how we act in every other part of our lives, right? When our favorite store has a 50% off sale, we get excited. We rush in to buy more. But for some bizarre reason, when the stock market goes on sale, we do the exact opposite. When prices are low, people panic and sell. When prices are sky high, they can't wait to buy. It's the only store in the world where customers run out screaming when things go on sale. It makes no sense.
In this image, this says it all. While everybody else is freaking out, running for the hills because Mr. Market is having a meltdown, the smart investor sees a once-in-a-decade bargain. They see fantastic, high-quality businesses being offered up for pennies on the dollar. Let's make this super concrete. Let's say you do your homework, you study a company, and you figure out it's truly worth about $10 a share. But Mr. Market is in a terrible mood, so he offers it to you for just $5. That's a great deal, so you buy some. Now the next week, he panics even more, and the price drops to $4. Most people would look at their account and think, oh no, I'm losing money. But you know the business is still worth $10. So this is fantastic news. You get to buy even more of a great thing at an even bigger discount. And this is the ultimate punchline to the whole story. You should never, ever let Mr. Market's price guide your decisions. You are in the driver's seat. His manic mood swings are there to serve you, to present you with opportunities. You can just ignore him for days, weeks, even years, and wait patiently until he offers you a price that you know is a bargain.
Okay, so we get the strategy now, but why does this work so incredibly well over the long haul? What's the secret sauce? Well, it's because stocks, which are just pieces of businesses, remember, are a very special kind of asset. They are productive. I absolutely love this way of thinking about it. Imagine that a single share of stock isn't just a piece of paper, but it's a tiny little business that you can hold in the palm of your hand. It's got tiny workers and a tiny factory, and it works around the clock 24/7, churning out a tiny stream of profit that flows directly to you. Now imagine you own 100 of these, or 1,000. And this right here is the fundamental difference. Productive assets, like businesses, actually create more wealth internally. They generate cash. But non-productive assets, things like gold, art, even cryptocurrencies, they don't. A bar of gold will be the same bar of gold 100 years from now. The only way you can make money from it is if you can find someone else who's willing to pay you more for it down the road. Its value depends entirely on someone else's opinion.
And when you look at the actual history, the numbers are just jaw-dropping. Over the entire 20th century, the price of gold went up about 20 times. Not bad, right? But over that same period, the Dow Jones average, which just represents owning a piece of America's biggest businesses, went from 66 to nearly 11,500. That is the incredible, undeniable power of owning productive, profit-generating assets.
So, we'll end with this one final thought. Every single day, Mr. Market is going to show up and offer you a price. He'll be ecstatic one day and terrified the next. The price is easy to find. It's plastered everywhere. But that's not the number that matters. The real question, the one that separates successful investors from everyone else, is this: do you know the value?
Welcome to The Explainer. Today we're going to dig into something that I think is going to change the way you look at investing forever. We're told it's all about picking the right stocks, right? Well, today we're going to challenge that. It's really about understanding the invisible forces that move the entire market. These are the core principles that, once you get them, really separate the successful investors from everyone else.
Okay, so let's just jump right in with the million-dollar question, the one that's on pretty much every investor's mind. How in the world do you beat the market? Most of us, we think the answer is to become some kind of stock-picking genius, to pore over spreadsheets for hours on end, trying to find that next diamond in the rough.
But what if I told you that's completely backward? The source material for this whole explainer argues that if you really want to win consistently, you have to look past the individual companies. You've got to understand the powerful, invisible currents that are shaping the entire financial ocean.
So here's our game plan for today. First, we're going to talk about the real first step every investor should take. Then we'll get into this awesome concept of money's gravitational pull. After that, we'll expose a silent threat to your wealth, and then we're going to make sense of the bond. And finally, we'll wrap it all up with a simple, actionable playbook. Ready? Let's do this.
All right, Section 1, Mastering the Invisible Forces. Look, before you can win any game, you have to know the rules, you have to understand the playing field. And in the world of investing, that playing field, well, that's the economic environment itself.
This quote right here, it just gets right to the heart of it all. The source puts it so bluntly. Consistent success is just not possible without really understanding these three things. They are the absolute foundation that everything else sits on. So let's start there and master these basics.
Now that we get why the big picture is so crucial, let's tackle the first of these invisible forces, interest rates. We're going to explore this idea of money's gravity, and I'm telling you, it might just be the most powerful force in the entire financial universe.
Seriously, the best way to wrap your head around interest rates is to think of them just like gravity. Like the physical force that keeps our feet on the ground. Interest rates are this constant, invisible pull on every single part of the economy, from the tiniest loan you could take out all the way up to the biggest corporations on the planet. This gives us a really cool way to visualize it. Just imagine for a second that you live on a planet where gravity changes every single day. So on day 1, gravity is normal, business as usual. But on day 2, boom, gravity doubles. Suddenly, everything is a struggle, it's heavy. Then, on day 3, gravity gets cut in half, and everything feels weightless and effortless.
And that is a perfect analogy for how interest rates work. High interest rates, that's like high gravity. It makes borrowing money expensive, it slows down business, it makes it so much harder for companies to grow. Only the absolute strongest can survive. And on the flip side, low interest rates are like low gravity. Money is cheap, and that encourages everyone to borrow, to invest, and it fuels economic growth.
Let's look at a real-world example, because this makes it super clear.
Say you have a $300,000 mortgage. At a 6% interest rate, you're paying $18,000 a year in interest. But drop that rate to 4% and suddenly it's only $12,000. That's a $6,000 difference. That extra cash makes buying a home possible for way more people, which drives up demand and in turn can make that asset, the house, more valuable. This is a perfect example of how interest rates create huge opportunities.
Okay, so this raises a huge question, right? If this financial gravity can shift so much and have such a big impact, who's the one turning the dial? Who has the power to make business easy or hard?
Well, the answer is the Federal Reserve, or what everyone calls the Fed. And this cartoon is a pretty funny take on the Fed as the ultimate controller of interest rates. Now, the Fed has two main jobs: keep prices stable and aim for maximum employment. So they use interest rates like a tool, either to give a boost to a slow economy or to pump the brakes on one that's getting too hot and might be creating an asset bubble. You know, when prices for things just get way out of whack with their real value.
But wait, it's not just the Fed setting rates. They're also determined by risk. The Fed sets the base rate. You can think of it as the floor. But then individual lenders adjust from there. So let's say you want to buy a $1,000 TV on credit. The store might offer you a loan, but at a crazy 20% interest rate. And you're thinking, why so high? Well, it's all about risk. Unlike a house, which a bank can take back if you don't pay, a used TV isn't worth much. That high interest rate is just the lender's way of getting paid for taking on the risk that you might not pay them back.
Okay, so we've covered interest rates, the gravity of the financial world. Now let's move on to another incredibly powerful and often really underestimated force: inflation. You should think of this one like a constant headwind or a silent drag on your wealth that is always working against you.
So to really get inflation, you have to understand the difference between nominal and real dollars. The nominal value is easy. It's just the number on the price tag. But the real value, that's what that money can actually buy you. It's your true purchasing power. Inflation is the thing that makes that gap between the two get wider and wider.
And this example really just brings it all to life. I mean, check this out. If your grandfather earned $1 an hour back in 1913, that was one nominal dollar. Simple. But in today's money, the real value, the actual purchasing power of that single dollar, is almost 24 bucks. That is the absolutely staggering power of inflation over 100 years.
So why do we even have inflation? You know, it seems like a bad thing. But believe it or not, governments actually kind of like having a little bit of inflation, and for a few key reasons. First, it nudges people to spend their money now instead of hoarding it, which helps get the economy moving. Second, you pay taxes on your nominal gains, not your real ones, so inflation can actually boost tax revenues. And third, it makes it easier for governments to pay back their massive debts over time with dollars that are worth less.
And for you as an investor, the effect of inflation is it's breathtaking. Look at this. $1 invested in 1913 would have grown to over $13,000 a century later. That's your nominal return. Sounds great, right? But after you factor in that silent drag of inflation, the real purchasing power of that investment is only $2,200. Inflation literally erased over 80% of the nominal gains. It's wild.
Okay, now that we've got our heads around interest rates and inflation, we can finally talk about our third key concept, the bond. And it is not just some boring investment for your grandparents. It's an incredibly powerful tool for navigating the very economic environment we've been talking about.
At its very core, a bond is shockingly simple. It's just a loan. That's it. When you buy a bond, you are lending your money to an organization. Could be a company, could be a government. And in exchange for your loan, they promise to pay you regular interest payments and then give you all your money back at the very end.
So every single bond has three basic parts. First, you've got the par value. That's just the face value of the loan, the amount you'll get back when it's all over. Next is the term, which is simply how long the loan is for. And finally, you have the coupon rate. That's the fixed interest payment you get every single year. See? It's really as simple as that.
All right, it is time to put all of these pieces of the puzzle together. We've talked about interest rates, we've talked about inflation, and we've talked about bonds. Now let's see how all this knowledge actually turns into a practical strategy you can use. This is the Investor's Playbook.
This slide right here basically boils down everything we've learned into one simple framework. Okay, so when interest rates are low, it's pretty clear that stocks are generally the place to be, no matter what inflation is doing. That's because cheap money is like rocket fuel for businesses.
But in a high interest rate, low inflation world, suddenly bonds become a really attractive option. Their fixed payments give you a solid, predictable return, especially when inflation isn't eating away at their value. In pretty much any other scenario, though, the growth potential you get from stocks usually wins out.
So we'll leave you with this final thought. You now get the fundamental forces of interest rates and inflation, the financial gravity and the silent drag on your wealth. You're familiar with the basic tools like stocks and bonds. The big takeaway here is that you don't have to make investment decisions in a vacuum anymore. You now have the lens to analyze the economic environment and make informed choices. So how will this new way of thinking change how you approach your very next investment?
All right, let's talk about financial statements. I know. Just hearing those two words can make your eyes glaze over, right? For a lot of people, it just brings up these images of super complex charts and jargon you can't even pronounce. But what if I told you they're just telling a story, and it's a story you already understand? In the next few minutes, we're going to learn how to read that story together. Yeah, this quote from our source material just hits the nail on the head. And it's true. I mean, at least with paint, you're getting a new color on the wall. But a financial report? What's the point? What is it even for? That's the real question we're going to answer. And I promise you, it's way more interesting than watching paint dry. And here's the secret. Here's the little trick to getting all of this. We're going to translate it all using something you are already an expert in, your own money. Seriously, a massive company's finances might seem crazy complicated, but they run on the exact same rules as your personal budget. They just have a lot more zeros at the end. So here's our game plan. First, we'll show you finance isn't that scary. Then we'll dive into the three big stories every company tells. The story about profit, the story about what it's worth, and the story about where the cash is. Then we'll wrap up by showing you where to find these official reports. Ready? Let's dive in. It really all comes down to how you think about your own money. I mean, you keep track of what you earn versus what you spend, don't you? You know what you own, your stuff, your assets, and you know what you owe, your debts. And you definitely watch the cash flowing in and out of your bank account. Well, a giant corporation is doing the exact same thing, just on a much bigger scale. And that's really all an annual report is. It's not some single monstrous document. Think of it more like a folder that has three main stories inside, or as our source calls them, three pieces of paper. You've got the income statement, the balance sheet, and the cash flow statement. And each one answers a different, really important question. So let's tackle that first one. First up, we've got the income statement. You'll often hear people call it the P&L, which just stands for profit and loss. Now, this document tells the story of how a company did over a specific chunk of time, like for a quarter or for the whole year. It's basically the company's report card. And this is the one fundamental question it answers. It's so simple, but so powerful. After a whole year of selling stuff and paying all the bills, did the company actually come out ahead? The entire statement is literally designed to lead your eyes down to that one single number at the very bottom. Okay, this slide right here, this is our Rosetta Stone. This is how we translate all that corporate jargon into plain English we use every single day. So when a company says revenue, just think your salary. That's all the money that came in. When they say expenses, those are just your bills. And that all-important number at the bottom, net income, that's simply what's left over. It's your savings. Let's look at it with some actual numbers. Let's say your salary is $20,000. That's your revenue. Now you start subtracting all your bills, rent, food, all the usual stuff. What do you have left? That $3,500? That's your profit. It's what you saved. A multi-billion-dollar company uses this exact same simple logic. So let's make it official. That number at the very bottom is called net income. Now, it's really important to remember that you'll also hear people call it earnings or just profit. They all mean the exact same thing. It's the final amount of money the company made after every single expense was paid. Now, investors like to take this one step further. They want to know what that profit means for just one single share of the company. This is called earnings per share, or EPS. And the math is easy. You just take the total net income, let's say it's about $2,800, and you divide it by the total number of company shares. So if there are 100 shares, the EPS is $28.63. It's a fantastic way to compare the profitability of different companies on a level playing field. Okay, let's move on to document number 2. We just saw how much a company made over a year, but the balance sheet, it answers a totally different question. It's not about a period of time, it's a snapshot, like a single photograph of the company's financial health on one specific day. And the question it's built to answer is this. If you could tally up everything the company owns and then subtract everything it owes, what is its actual net worth today? It's a measure of its solid foundation. And I know what you're thinking. You look at a real one like this, and it just seems insanely complicated. You've got all these lines for accrued expenses and goodwill. It's a lot. But again, don't worry about the jargon. The idea behind it is incredibly simple, and we can prove it with our personal finance analogy. Look at this. On the left, you list out your assets. That's all the stuff you own, like your car and your house. Then you list out your liabilities. That's everything you owe, like your car loan and your mortgage. The magic happens when you subtract what you owe from what you own. That difference, that's your equity. It's what you truly own, free and clear. It's your net worth. This idea of equity is the absolute heart of the balance sheet. Now, for a company, you'll hear it called a couple other things, like shareholders' equity or book value, but it's the exact same math, total assets minus total liabilities. It represents the owner's real stake in the company. Now, here's something that always confuses people, so let's clear it up. Why in the world is equity, the company's own value, listed on the same side as liabilities, the money it owes to other people? Well, it's because from the company's point of view, as a separate legal thing, it owes that value back to its owners, the shareholders. It's a liability to the company, but it's an asset to the owners. And hey, just like with earnings, investors love to break this down to a per-share number. They take the total equity, in this case about $18,000, and divide it by the number of shares. This gives us the book value per share, $183.98. It's another one of those key numbers investors look at to get a feel for a company's real underlying value. All right, on to our third and final statement. We've looked at profit over time, and we've looked at net worth in a moment in time. But you know that old saying in finance, cash is king. Well, the cash flow statement explains exactly why. It doesn't care about any accounting theories. It only cares about one thing, where the actual physical cash went. And this difference is absolutely critical. An income statement can show a huge profit because it records a sale on credit, even if the cash hasn't actually shown up yet. But the cash flow statement, that's the ultimate reality check. It only cares about cash in and cash out. And this is so important because a company can look really profitable on paper, but still go bankrupt because it literally ran out of money. Just think about your own bank account statement. That's your personal cash flow statement. It shows your paycheck coming in and all your bills going out. The final number is the actual cash you have left in the bank. A company tracks this in the same way, just with a few more details. It's a reality check on whether they have enough money to operate. Okay, so we've done it. We've broken down the three core statements, the income statement, the balance sheet, and the cash flow statement. So now you're probably wondering, where do you actually find these things? Well, they're bundled into official reports that public companies are required to file with the government. And you'll mainly find them in three key reports. The 10K is the big one. Think of it like the company's annual yearbook. It has all the detailed stories from the entire year. The 10Q is more like a quarterly report card. It's a less detailed check-in that they file every 3 months. And the 8K, that's the breaking news alert. It's filed unexpectedly whenever something major happens, like a big merger or bankruptcy. And just like that, you now have the keys to unlock any company's financial story. You can use these three statements to see its profit, its net worth, and its real cash situation. But, understanding the story is just the first step. The real question for any investor is, how do you use that story to figure out what a company's true value really is? Well, that's the next step on the journey. When you hear the name Warren Buffett, you probably think of incredible investing success, right? But what if I told you that his entire multi-billion-dollar empire is built on just 4 really simple, common-sense ideas? It's a strategy that completely ignores the daily market hype, all the noise, and instead focuses on just one thing, buying amazing companies, but only at a fair price. So let's break down exactly how he does it. So that really is the big question, isn't it? I mean, we live in a world of super complex algorithms, high-frequency trading. So how did this one guy from Omaha, Nebraska, manage to consistently beat the market for decades using a strategy he's totally happy to tell anyone about? Well, the answer is actually surprisingly simple. And here they are. This is it. The whole foundation is built on these 4 pillars. First, you got to look for vigilant, responsible leaders. Second, the business itself needs to have real, long-term prospects. Third, it has to be stable and, understandable. And finally, the most important part, You only pull the trigger when you can get it at an attractive price. Every single investment decision he makes has to pass all 4 of these tests, no exceptions. So here's our game plan. We're going to dive deep into each one of these principles. We'll start with how to spot those vigilant leaders. Then we'll get into why thinking long-term gives you this massive, massive advantage. After that, we'll talk about stable businesses, and finally, how to know what the right price actually is. And to wrap it all up, we'll look at the investor's mindset, which is really the glue that holds all of this together. Okay, first up, vigilant leaders. Before you even think about what a company sells, you have to look at the people steering the ship. Are they careful with money? Are they responsible? Are they running the company like it's their own, or are they just trying to line their own pockets? For Buffett, this is always step 1. So how can you tell if the leaders are being responsible? Well, this table gives us a few awesome shortcuts. First, check the debt-to-equity ratio. Buffett wants to see this below 0.5. See, too much debt makes a company slow and clumsy. You want a nimble speedboat, not a giant cruise ship that can't turn around. Second, the current ratio. If it's above 1.5, that's a good sign they can easily pay their bills. And finally, return on equity, or ROE. This needs to be consistently above 8%. This is one of Buffett's favorites because it basically tells you how good management is at turning $1 of your money into more dollars.
And all of this gets to the absolute heart of Principle 1. It's something called the principal agent problem. Sounds a little academic, but the idea is simple. You, the shareholder, you're the principal, you're the owner. The management team, they're your agents, hired to work for you. The big question is, are they actually doing that? Are they focused on building value for the long haul? Or are they just trying to pump up the stock for a few months to get a fat bonus? Vigilant leaders always work for the owners.
Okay, so let's move on to the second principle. Once you've found a team of great managers, you need to make sure they're in charge of a great business, one that's going to be around for a long, long time. We're not looking for the latest fad. We're looking for things people will still be buying decades from now. And this is Buffett's brilliant little mental shortcut. Just ask this one simple question. Think about it. Will the internet fundamentally change the way people drink Coca-Cola? Probably not. We've loved sweet, bubbly drinks for ages. But will it change the latest tech gadget? You bet it will. This question is a fantastic filter to weed out businesses that are easily disrupted and focus on the ones with true staying power. So why is this long-term focus so incredibly important? Well, beyond just finding a durable product, there's a huge financial reason that a lot of people miss: taxes. Every single time you sell a stock for a profit, you have to pay taxes on that gain. And if you sell it too quickly, you pay at a much higher rate. This acts like a constant anchor, dragging on your returns and stopping your money from really growing on its own. And you don't have to take my word for it, just look at the math. On the left, you see what happens when you just buy and hold. On the right, you can see that constant drag from selling and paying taxes year after year. That little difference adds up to a huge gap over time, which brings us to the final result. And here is the final scorecard. The person who just held on has over $293,000. The active trader, just barely over $200,000. That is a $92,000 difference. All of that money just vanished, lost to the friction of taxes and trading. This just goes to show that finding a company you can hold for the long haul isn't just a nice idea. It's a critical part of the whole financial strategy. Which leads us right into Principle 3. So you've found good leaders, you've found a product that's built to last. Now you need to be sure the business itself is stable, and just as important, that you can understand it. This is all about cutting down your risk by just avoiding things that are too complicated or unpredictable. Buffett calls this staying inside your circle of competence. You don't have to be an expert in everything. In fact, he'd say you absolutely shouldn't be. Just stick to the industries and the businesses that you genuinely get. Can you explain, simply, how the company makes money? If you can't, it's outside your circle. You don't get extra points in investing for playing on hard mode. So what does a stable business actually look like on paper? It looks like this. Check out these charts for things like earnings per share and dividends. You're not looking for crazy, jagged spikes that go all over the place. Nope. You're looking for exactly this: smooth, steady, predictable lines that just keep chugging along, up and to the right. Now, a huge part of what creates that stability is what Buffett famously calls an economic moat. He wants you to think of a great business like a fantastic castle. And the moat, well, that's its competitive advantage, the thing that protects it from all the invaders, who are the competitors trying to take its profits. The wider and deeper that moat is, the safer your castle is.
And these moats can look like a few different things in the real world. Sometimes it's an intangible asset, like the brand power of Disney. You just can't replicate that. Sometimes it's a low-cost structure, like how Walmart is so massive it can sell things cheaper than anyone else. And sometimes it's high switching costs. I mean, think about what a nightmare it would be for a big company to switch all of its computers away from Microsoft Windows. That stickiness is an incredibly powerful moat.
All right, we've found our perfect company. It's got great leaders, it's going to be around forever, and it has a wide moat protecting it. We're now at the final and most critical step, buying it at an attractive price. Because even the best company on earth can be a terrible investment if you pay too much for it. This chart shows the concept perfectly. That black line, that's what the company is actually worth. That's its real intrinsic value. The red line is the crazy, emotional up and down market price. See that huge gap between them? That is your margin of safety. Buying your shares down in that zone is your protection, your safety net in case you're wrong about something. And it's exactly where all your future profit comes from. So how do you spot a potential bargain? Well, two really quick ratios to check are the PE and the PB. As a really general rule of thumb, value investors get interested when a company's PE is under 15 and its PB is under 1.5. Now, these aren't magic numbers, but they're a fantastic first filter to run when you're looking for companies that might be on sale. And that brings us to the final and maybe the most important piece of this whole puzzle. We've covered the 4 principles. They're logical, right? They're pretty simple to understand. But actually doing them day in and day out, that is not easy. It takes a very specific kind of mindset. So let's put it all together into one final checklist. First, you find those vigilant leaders who are smart with debt. Second, you pick businesses with products that can stand the test of time. Third, you have the discipline to stick inside your circle of competence with stable companies protected by a wide moat. And finally, the golden rule, be patient and only buy when the price gives you a big margin of safety. Which brings us to the last thing I want you to think about. Buffett himself is famous for saying that the principles are simple, but the execution is really hard. It takes incredible patience to wait for the right price. It takes discipline to not chase after shiny objects outside your circle of competence. And it takes guts to buy when everyone else is selling. So looking at this list, which one of these do you think requires the most discipline? Which one would be the hardest for you to stick with? That's a question every single investor really has to answer for themselves.
Have you ever opened up a company's annual report and just felt lost, like you're trying to read a completely foreign language? Well, today we are going to crack that code. We're breaking down financial statements, which are absolutely the key to understanding what is really going on inside a business you've invested your hard-earned money in.
You know, Warren Buffett famously said that accounting is the language of business. And that's not just some clever little phrase. It's the most important idea for any investor to grasp. If you want to understand a company's story, its wins, its losses, its secrets, you have to speak the language it's written in.
So let's get right to the heart of the matter. When you buy a stock, you literally become a part owner of that company. But you're not in the boardroom, you're not there for the day-to-day grind. So how on earth do you really know what's going on with your investment?
Well, this is a classic challenge in business, and it has a name, the principal-agent problem. You, the owner, are the principal, and the managers who are actually running the show, they're the agents. Because you're separate, there has to be a reliable, standardized way for them to report back to you on how things are going.
And that's where financial statements come in. They're the bridge between you and the company. In fact, they are the single most important form of communication between the management team and you, the owner. They're designed to give you a clear, honest look at the real state of the business.
So here's our game plan for today. We're going to start with the language of business itself. Then we'll get into the basic grammar, debits and credits. After that, we'll look at 2 very different ways of telling a company's financial story. And finally, we'll get to the most important part, how to follow the real money.
All right, first up, let's talk about mastering the grammar of finance. Because if you really want to understand the story the numbers are telling, you have to start with the one foundational rule that governs absolutely everything in accounting.
And that big rule is called double entry accounting. The core idea is actually pretty simple. Every single transaction has 2 sides. A gain in one place has to be balanced by an entry somewhere else. It's this beautiful, elegant system that makes sure the financial picture is always complete and perfectly in balance.
So let's peek under the hood a little bit and look at the financial plumbing. How does this whole system of debits and credits actually work? And don't worry, this isn't going to get too technical. We're going to keep it really clear and simple.
Okay, now don't let this chart freak you out. You do not need to memorize this. The big takeaway here is just that there's a strict set of rules, a grammar, that keeps all the books balanced. An increase in something you own, like cash, is treated differently than an increase in something you owe, like a loan. That's what ensures every transaction is categorized just right.
To visualize all this, accountants use a really simple tool called a T account. Seriously, just think of it as a piece of paper with a T drawn on it. It's got two columns, one for debits on the left, one for credits on the right, and it helps them track both sides of every single transaction.
All right, theory is one thing, but let's make this real. Let's walk through a super common example. Imagine a company goes to a bank and borrows $10,000. How would this one simple event get recorded using the rules we just talked about? Here's that double entry system in action. On one side of the T, the company's cash account, which is an asset, goes up by $10,000. But of course, that money had to come from somewhere. So on the other side, its debt, a liability, also goes up by $10,000. See? One transaction, two entries. The books stay perfectly balanced.
Okay, so what happens next? Let's say a few weeks go by and the company makes its first payment on that loan, $1,000. It's the exact same principle, just in reverse. The cash account, an asset, goes down by $1,000, and at the exact same time, the loan, which is a liability, also goes down by $1,000. Every single transaction keeps the system in perfect harmony.
Now, here's the really crucial point. You are probably never going to make a T account yourself, but understanding this system is the key, because it proves that money never just appears out of thin air or vanishes. It always moves from one place to another. Your job, as an investor, is to be the detective and figure out where it's moving.
Now, this is where things get really interesting because it turns out there are two completely different ways to tell this financial story. You can either follow the actual cash as it moves, or you can follow the clock as time marches on.
So, on one hand, you've got cash-based accounting. It's as simple as it sounds. You only record something when money actually changes hands. But on the other hand, you have accrual accounting. And with this method, you record revenue when you've earned it and expenses when you've incurred them, even if no cash has moved yet. And here's the key. All publicly traded companies have to use the accrual method.
Let me tell you a quick story to make this crystal clear. Imagine your company sells 10,000 beach balls to Walmart, a huge order. But Walmart has terms, and they agree to pay you in 90 days. Well, under accrual accounting, you get to book all of that revenue today, the minute you make the sale, not 3 months from now when the money actually hits your bank account. And that right there, that highlights the huge potential problem with accrual accounting. Your income statement could show a massive, beautiful profit from that big sale. But what if the cash never actually shows up? This is the disconnect every investor needs to understand. Reported profit is not the same thing as cash in the bank.
So how can an investor possibly cut through this fog of accrual accounting to find out where the real money is? Well, we need a tool that can translate those on-paper profits into actual cash. We need a financial Rosetta Stone.
What's pretty crazy is that this tool is actually pretty new. Before 1987, investors only had 2 of the 3 main financial statements. They could see if a company was supposedly profitable, but they had no easy way of knowing if that profit was turning into cash. Then, everything changed when the cash flow statement became mandatory. I mean, think about that blind spot for a second. A company could look fantastic on paper, profits going up, assets growing, all while it was secretly running out of actual cash to pay its bills. The cash flow statement was literally designed to shine a bright light right into that dark corner. And this is its power. This is the single biggest takeaway for any investor. The cash flow statement is the ultimate truth teller. It takes the on-paper net income from the income statement and it reconciles it with the actual real cash that flowed in or out of the business. It is the one document that tells you the real story.
Because at the end of the day, that's what this is all about. The numbers on these statements aren't just figures on a page. They're the characters and the plot points in the ongoing story of a business. So now that you're starting to learn the language, the only real question left is, what stories will you uncover?
Welcome to The Explainer. Today, we are going to pull back the curtain on a company's profit story. We're doing it by breaking down one of its most important financial documents, the income statement. Yep, we're going from the very first sale all the way down to the final dollar of profit. You know, you can't really talk about this stuff without bringing up this famous quote from Warren Buffett. Because that's exactly what we're doing today, right? We're learning the language of business. And once you know the rules, you can understand the story any company is trying to tell you. But what if this whole thing feels, well, impossible? If you've ever looked at one of these statements and your eyes just glazed over, you are definitely not alone. It can feel really confusing because it seems like every company uses different names, different layouts. It's like you're starting from scratch every single time. But here's the good news. The secret, really. They don't. Underneath all those cosmetic differences, every single income statement on the planet follows the exact same basic logic. And that's what we're going to break down together today. All right, so here's our game plan. First, we'll get the basic story down. Then we'll look at all the money coming in, then all the money going out. After that, we'll follow the math all the way down to the final profit. And finally, the fun part. We'll see how to use all this info to make some really powerful comparisons. Okay, let's just dive right in. To understand any journey, you gotta have a map, right? So let's introduce our guide for today's adventure into company profits. Okay, take a look at this. This right here is our map, a sample income statement. Now I know, it probably just looks like a wall of numbers right now, but stick with me. We are going to break down every single part of this, and by the end, I promise, every line will make perfect sense. We'll keep coming back to this. So at its absolute core, the income statement tells a story. Think of it like a journey from one place to another. It always starts at what we call the top line. That's all the sales or revenue a company brings in. And it ends up all the way down at the bottom line. That's the final profit, the net income left over after every single bill has been paid. So let's start that journey at the very, very top. We're going to explore all the ways that money flows into a company. And, it's not always as simple as just selling something. There are really three main buckets for all the money coming in, and each one tells us a little something different. You've got money from the main business, money from side gigs, and then these occasional one-off windfalls called gains. First up, and this is the big one, is primary revenue. This is the company's bread and butter. It's the money it makes doing what it's famous for. If you're Coca-Cola, it's the cash you get from selling soda. This is the engine that drives the whole train. And if we peek back at our map, we can see the starting point. Check it out. This company pulled in over $13 billion from its main business in just 1 year. That is our top line, right there. But, companies make money in other ways too. They might have a ton of cash just sitting in a bank account earning interest. That's secondary revenue. Or maybe they sell an old warehouse for more than they paid for it. That profit is called a gain. These aren't part of the main business, and they often don't happen every year. All right, we've seen how money comes in. Now for the other side of the equation. Where does it all go? You got to spend money to make money after all. And just like the money coming in, the money going out gets split into a few key buckets. You've got the direct costs of what you're selling, all the costs of just running the business, financial costs like paying interest on loans, and then sometimes one-off losses. So the biggest chunk of expenses usually is what we call cost of revenue. You'll hear it called COGS or cost of goods sold all the time. These are the costs tied directly to what you're making. For a soda company, that's the sugar, the aluminum for the can, the wages for the people on the factory line. The more you sell, the higher this number gets. So let's look at our company. How much did it cost them to make all that stuff they sold? A whopping $5.3 billion. That's just the direct cost of doing business. Then you have everything else you need to just, keep the lights on. These are your operating expenses. Think about it. All those TV commercials, the salaries for the marketing team and the CEO, the money spent researching the next big thing. You can't tie these costs to one single can of soda, but the business would fall apart without them. All right, so we've got the money in pile and the money out pile. Now let's see how they actually stack up against each other. We can literally just follow the math down the page to see how much profit is left at each stage. Honestly, it's just a series of simple subtractions. You start with that big revenue number at the top. You take out the direct cost of making your stuff, and boom, that gets you to gross margin. Then from that, you subtract all the operating costs, and that leaves you with income from operations. And finally, after you pay your interest and taxes, you get to the big one, net income. Okay, I want to pause right here. See that line, income from operations? It's often called EBIT. This number is so important. Why? Because it tells you how good the company is at its actual day-to-day business, before you even think about how they paid for it all or what their tax bill looks like. It's a pure measure of how well the business is running. And then, after every single cost, every expense, every tax dollar is paid for, you finally get to the grand finale, the bottom line. For our company, that's a net income of over $2.8 billion. That is the actual take-home profit for the company's owners that year.
Okay, so now we can read the statement. That's fantastic. But the real magic, the real power, comes when you start using these numbers to ask some smart questions and compare companies.
And we do that with something called ratio analysis. It's just a fancy way of saying we use simple formulas to turn these giant, intimidating numbers into simple percentages. This lets us do a true apples-to-apples comparison between our company and, say, its biggest competitor, who we'll just call Pepsi. So let's start with gross profit margin. This basically asks, for every dollar in sales, how much is left after paying for the product itself? And you can see here, our company keeps about 60 cents, while Pepsi keeps almost 63. This kind of suggests Pepsi's a little bit more efficient at just making its product. But wait, the story totally flips when we look at the operating margin. Remember, this includes all the overhead costs, marketing, salaries, all that stuff. And what do you know? Our company is actually leaner and meaner. It's more efficient when it comes to running the entire business.
And this right here is where it all comes together. The final score, net income margin. Our company is just crushing it. It turns almost 22 cents of every single dollar of sales into pure bottom line profit. That blows Pepsi's 12 cents out of the water. It tells us our company is a master at managing its debt and taxes.
And finally, let's just talk about risk for a second. How safe is this company? Well, this ratio, the interest coverage ratio, tells us exactly that. It shows our company's operating income could pay its yearly interest bill more than 30 times over. That is an incredibly safe cushion. So you see, the income statement tells a fascinating story about a company's past performance. But once you learn the language, once you know how to read between the lines, you can start to see clues about its future. So the real question is, now that you can read the story, what are you going to look for next?
All right, let's talk about the balance sheet. I know, it can sound a little intimidating, but trust me, it's not as scary as it looks. By the end of this, you'll see that it's really just a powerful one-page snapshot of a company's financial health at a single point in time. So let's dive in and demystify this thing.
So to get our bearings, let's start with that big 30,000-foot view. A balance sheet really just boils down to three main parts. First up, you've got assets. That's all the stuff the company owns that's going to help it make money in the future. Think factories, equipment, cash in the bank. Then you've got the two ways a company pays for all that stuff. Either with liabilities, which is just money it owes to other people, or with equity, which is the money that belongs to the owners of the company. That's it. That's the whole game.
You know, to really make this click, let's use a super simple analogy. Imagine you go out and buy a car for $10,000. That car, that's your asset. Now you put down $2,000 of your own cash. That's your equity. It's your stake in the car. The other $8,000 you borrow from the bank, and that's your liability. See how that works? The $10,000 asset is perfectly balanced by the $8,000 you owe and the $2,000 you own. That simple logic is the engine that makes the whole balance sheet run.
So here's our game plan for today. We're going to start with that fundamental equation we just talked about. Then we'll take a tour of what a company owns, its assets. After that, we'll look at what it owes, the liabilities. Then we'll unpack the owner's stake, or equity. And finally, the best part, we'll put it all together and learn how to actually read the financial story that the balance sheet is trying to tell us.
Okay, so let's take that simple car idea and formalize it. We're about to look at the single most important equation in all of accounting. This is the bedrock, the foundation of everything.
And here it is. Assets equals liabilities plus equity. This isn't just a suggestion. It's like the law of gravity for accounting. It is unbreakable. Everything a company owns has to be paid for by either someone else's money, a liability, or the owner's money, equity. The two sides of this equation must always be equal. They have to balance. And hey, that's why they call it a balance sheet. Okay, first stop on our tour, the asset side of the equation. Remember the rule of thumb. An asset is just something the company owns that it expects to use to make money in the future. If you're ever looking at a balance sheet and you're not sure about an item, just ask yourself, can this thing generate cash for the company down the road?
Now, accountants love to split things into buckets, and assets are no exception. They're divided into two big categories based on one simple thing: how quickly can you turn it into cash? On one side, you have current assets.
These are the things the company expects to use up or convert to cash within the next year. On the other side, you have non-current assets. Think of these as the long-term workhorses of the company, things that are built to last. That one-year mark is the magic dividing line.
So let's pull up a sample balance sheet, which we'll keep coming back to. As you can see, right at the top of the assets column, you've got that current assets section. These are all the resources that keep the day-to-day operations running. And you'll notice they're usually listed in order of liquidity, starting with the stuff that's basically already cash and moving down from there.
So what kind of stuff are we talking about here? Well, first there's the obvious one, cash and equivalents. Can't get more liquid than that. Then you have accounts receivable. This is basically a pile of IOUs from customers who bought stuff on credit and haven't paid yet. Next is inventory, raw materials, stuff being built, and finished goods ready to fly off the shelves. And finally, you see things like prepaid expenses, which is when a company pays for something upfront, like an insurance policy for the whole year.
Okay, so we've got the short-term stuff down, but now let's talk about the non-current side, because this is where one of the most fascinating ideas in all of finance lives. I want you to think about this. Why on earth would a company ever pay, say, $200,000 for another business when all its physical assets, its buildings, its inventory, are only worth $150,000? Where does that extra 50 grand come from? What are they paying for?
The answer is a really cool, kind of weird, intangible asset called goodwill. That extra 50 grand is the price tag for all the valuable stuff you can't see or touch. We're talking about a killer brand name, a super loyal customer base, a secret recipe, the company's secret sauce. And here's the crucial part. A company can't just decide it has goodwill and write it on its own balance sheet. No way. Goodwill only gets created when one company buys another for more than its assets are worth on paper, because the buyer believes all that intangible secret sauce is going to be a gold mine in the future.
Okay, so we've covered what the company owns, but how did they pay for it all? That brings us to the other side of our equation, where we look at how those assets are financed. We're moving on to liabilities, which is just the fancy word for the portion of the assets paid for with other people's money.
And you guessed it, just like with assets, liabilities get split into those same two buckets, using that same 12-month dividing line. You've got your current liabilities. These are the bills and debts that are coming due soon, within the next year. And then you have your non-current liabilities, which are the longer-term debts that the company has a bit more breathing room to pay off.
Let's pop back to our sample balance sheet. See how the liabilities section is split nice and neat between current and non-current? This is so useful because it lets you see at a single glance what immediate financial pressures the company is under versus the long-term debt it's carrying.
So, what do these look like in the real world? Well, accounts payable is the mirror image of accounts receivable. It's money the company owes to its suppliers. In a way, it's like getting a short-term, interest-free loan from them. Then you have accrued expenses. These are for things the company has already benefited from but hasn't gotten the bill for yet, like the salaries its employees earned this month. Notes payable are just short-term loans, and long-term debt is, well, it's exactly what it sounds like. Big loans that aren't due for at least a year.
Okay, deep breath. We're about to tackle a concept that trips a lot of people up, deferred tax. But don't worry about memorizing these numbers. The core idea is actually pretty simple. Companies often have two sets of books, one for their investors that follows accounting rules, and one for the tax man that follows tax law. Sometimes, those different rules let a company pay less tax today than you think. But, and this is a big but, the tax authorities always get their money eventually. So that tax bill that's been pushed into the future, it gets recorded on the balance sheet as a deferred tax liability. It's really just all about a timing difference.
All right, we've covered what the company owns in assets and what it owes to others in liabilities. So, what's left? That brings us to the final piece of our puzzle, equity. You can think of it as what would be left over for the owners if the company sold all its assets and paid off all its debts today. It's the owner's slice of the pie.
Now here's a mind bender for you, a really key insight. From the company's perspective, and remember, legally a company is its own separate entity, equity is actually a type of liability. It's the money that the business technically owes back to its owners, the shareholders. That's why you find equity on the same side of the balance sheet as liabilities. They're both claims against the company's assets.
One of the line items you'll often see in the equity section is something called treasury stock. This pops up when a company buys back its own shares from the open market, and it's a really powerful tool. Just look at this example. Before the buyback, you own 1 out of 100 shares, so you own 1% of the company. But after the company buys back a couple of shares, there are only 98 shares left in the world. You still own 1 share, but now your ownership stake has just ticked up to over 1%. Your slice of the pie just got a little bit bigger, and you didn't have to do a thing.
Pretty cool, right?
Okay, we've done the hard work. We understand the pieces, assets, liabilities, and equity. Now for the fun part, the real payoff. We can use these numbers to do a quick financial health checkup on a company, just by calculating a few simple but incredibly powerful ratios.
One of the absolute go-to ratios for checking a company's financial risk is the debt-to-equity ratio. It answers a really simple question: how much is the company relying on borrowed money versus the owner's own money? The calculation is easy. You just take all the debt that charges interest, that's long-term debt plus notes payable, and you divide it by the total equity. So for our sample company, we plug in the numbers and we get a result of 0.202.
So that works out to a debt-to-equity ratio of 20.2%. But what does that actually mean? A number by itself is totally useless, right? Is 20% good? Is it bad? How do we know if this company is risky or safe? We need some context.
Here's a really simple way to think about it. This number means that for every $100 the owners have invested in the business, the company has gone out and borrowed an extra $20.20. Now, that debt adds risk because you have to make interest payments no matter what. To give you a real-world benchmark, a famously cautious investor like Warren Buffett, he generally likes to see this ratio stay below 0.5 or 50%. It tells him the company isn't overloaded with debt. So our company, at just over 20%, looks pretty healthy and conservative by that standard.
And that's really the key takeaway here. A balance sheet is a photograph, a snapshot of a company on one particular day. The real magic happens when you start comparing these photos over time. So I'll leave you with this question to chew on. If you came back and looked at this company's balance sheet 1 year from now, what changes would you want to see? Would you want more cash, less debt? What changes would tell you, hey, this company is winning? Something to think about. Thanks for joining me.
All right, let's put on our detective hats. Today, we're cracking open the case file on one of the most revealing documents in all of finance, the Statement of Cash Flows. Now, this thing is just packed with clues about a company's real health, and I promise by the end of this, you'll know exactly how to read them. So let's get started.
So here's the central mystery we're trying to solve. A company ends the year with more cash in the bank than it started with. I mean, on the surface, that sounds fantastic, right? But hold on. What if that extra cash came from a gigantic loan the company had to take out just to keep the lights on? See? Suddenly, that picture looks completely different. This is exactly the kind of puzzle the cash flow statement helps us solve. Okay, so the first thing we absolutely have to get straight is the huge difference between profit and cash. You've heard of net income, right? The famous bottom line? Well, that's really just an accounting concept. It's theory. It includes things like sales made on credit, where the company hasn't actually been paid yet. Cash flow, on the other hand, that's reality. It's the actual hard cash moving into and out of the company's checking account. Here's a great way to think about it. Imagine you could secretly look at your friend's bank statement every month. You wouldn't just see their final balance, would you? No way. You'd see their salary coming in, what they spent on rent, on groceries, maybe a loan they took out. That is exactly what the cash flow statement does for a company. It is the ultimate truth teller. So our investigation is really broken down into 3 parts, and we're going to start with the first and honestly the most important clue of all, cash flow from operations. This part tells us if the company's core business, the very reason it even exists, is actually generating cold, hard cash. Right here, this is the first section of our case file, and you can think of it as the company's heart. We want to see if it's pumping strong. The key number is right there, cash flow from operating activities. This is the cash that comes from the day-to-day business. You know, selling cars if you're Ford or selling coffee if you're Starbucks. A strong positive number like the 3,098 we see here, that is a very, very good sign. So how do we actually get to this super important number? Well, we follow a little 3-step process. First, we start with that reported net income we talked about. Then, and this is key, we add back any expenses that were on the books but didn't actually involve cash leaving the building. And finally, we make some adjustments for cash that's kind of tied up in the daily grind of the business. Okay, one of the biggest adjustments is for something called depreciation. Let's say a company buys a new machine for a factory. Now, the cash to pay for it might be gone in year 1, but for accounting, they spread the expense of that machine out over many years. That yearly expense is depreciation. It lowers the company's profit on paper, but since no actual cash left the company that year for it, we have to add it back to get to the real cash picture. It's like correcting for an accounting illusion. Our next piece of evidence is working capital.
You can think of this as cash that's just stuck in transit. For instance, if a company has a ton of unsold products just sitting in a warehouse, well, that's cash tied up in inventory that it can't use. But on the flip side, if it gets better at collecting payments from its customers, that frees up cash. So, and this sounds a little weird, a decrease in working capital is actually a good thing for cash flow.
So, after all is said and done, here's the bottom line for our first clue. A healthy, sustainable company has to be a cash machine from its main business. If it's relying on other things to generate cash, that's kind of like an employee relying on winning the lottery instead of their paycheck. It's just not a good long-term plan.
All right, let's move on to our second clue, the investing section. This is where we find out where the company is placing its bets for the future. Is it building new factories, buying up competitors, or is it selling off the office furniture just to stay alive? This section tells that story. Looking at our evidence file again, this middle section here, this is where we track all the cash spent on or received from long-term assets. This is all about the company's growth strategy. The numbers you see here tell you a lot about how confident management is about the company's future. Now here's where our investigation takes a little twist. In this section, a negative number, meaning cash is flowing out of the company, can actually be a sign of health. I know, it sounds weird. Why would spending a bunch of money be a good thing? Well, it's because that negative number usually represents investment. It means the company is buying new equipment, upgrading its factories, or developing new technology. We call this capital expenditure, or CapEx for short. And you want to see this. A company that doesn't reinvest in itself is like a rundown hotel that never renovates. Sooner or later, nobody's going to want to stay there. A positive number here could be a red flag that they're selling things off just to raise cash.
And that brings us to our final, and often the most revealing clue, financing activities. Seriously, if there are any skeletons in the corporate closet, this is usually where a good detective is going to find them. This section shows us exactly how the company deals with its owners and its lenders.
Let's zoom in on this last big section of the report. What we're looking at here is cash that comes from things like issuing new stock or buying its own stock back. It also includes taking on new loans, paying off old debt, and, of course, paying dividends to shareholders. Every single number here tells a story about who owns the company and how it's funded. So these are really the four main moves a company can make in this section. It can bring cash in by either issuing new stock or taking on debt, or it can send cash out by buying back its own stock or paying dividends. What you ideally want to see in a healthy, mature company is that it's strong enough to send cash out to reward its owners, not constantly needing to bring cash in just to operate. Now, let's think about issuing stock for a second. When a company needs to raise money, it's got options. As you can see from this little example, issuing new stock is just another choice, like taking out a bank loan. And it has a real, effective cost to the existing shareholders because their ownership piece of the company gets watered down. It is absolutely not free money. Now, on the flip side, management can use company profits to buy back its own shares. This is the exact opposite of issuing new stock. Instead of watering down your ownership, it concentrates it. It gives every remaining shareholder a slightly bigger piece of the pie. The alternative is to just keep that cash and reinvest it to try and make the whole pie bigger. A really smart management team will do buybacks when they think their own stock is selling for cheap. And this brings us to what might be the single most critical red flag in our entire investigation. If you discover that a company's operations are burning through cash, so that's a negative number, but its financing activities show a big cash inflow from new debt, that's a 5-alarm fire. It means the company is literally borrowing money just to pay its bills. A smart detective and a smart investor stays very, very far away from that situation.
Okay, we've gone through all the evidence. We've seen how the company makes money from its business, how it's investing for the future, and how it's getting its funding. Now it's time to bring it all together, solve this thing, and deliver the final verdict.
And here it is, the big reveal. You take the cash from operations. You add the cash from investing, which, remember, is usually a negative number, and you add the cash from financing. That total perfectly equals the exact change in the company's cash balance for the entire year. It all adds up, the mystery is solved. There's no more guessing, just the hard facts revealed by the flow of cash.
But hold on, our investigation has actually uncovered one final, ultimate clue. This is the number that many of the world's best investors focus on above all else.
It's called free cash flow. This is the pure, leftover, excess cash the business generates after all the bills are paid and after all the necessary investments have been made. This is the money that truly, truly belongs to the owners.
And the best part is, the calculation is beautifully simple. You just take that cash flow from operations we found in our first clue, and you subtract the money spent on things like new factories and equipment, that CapEx number we talked about. What's left over is free cash flow. In this case, that's $1,749 million. That number right there represents the true economic power of the company.
So, case closed. You are now officially equipped to be a financial detective. The next time you see some headline about a company's record profits, you'll know to dig a little deeper, to follow the money. You'll know to ask the real question. That's great, but show me the cash.